How's it going, guys? It's In the Money. I want to warn you against the fear mongering that's happening when it comes to the stock market crash, because there's a lot of people that are saying that because the stock market is crashing, it could stay flat for years and your money might be wasted and you should maybe just sell now. Or perhaps they're just, if you had your money in it, you're just bag holding at this point because the stock market's easily going to trade flat for 5 years. I want to kind of disprove that point because historically there have been periods of flat stock market returns where from point A to point B it's a 0% return overall, whether you're looking at NASDAQ, QQQ, S&P 500, SPY, or Dow Jones Industrial Average if you're a boomer. There have been periods, in fact, decades, in which there were flat returns. And that's being shared around as a way, I guess it's just a fear monger during a bear market and a impending recession, but I don't think it's an accurate picture of what actually happened during those periods of time. So let's take a look at those periods of time, some of them, and see what that actually looks like realistically. To do that, we're going to be using TradingView. TradingView is amazing. I encourage you to sign up for TradingView. I'm affiliated with them. They're down below in my Linktree link, and you should sign up for Pro Plus. You get all sorts of stuff. You get stock charts, indicators, you get ideas from other people. You can share ideas. You can rise your ranks, rise up to the top of the ranks. You can see economic data come in real time. You can see economic calendars. You can trade on TradingView with certain brokerages. You can enter your own, I'll stop there. They have everything. So I encourage you to sign up with TradingView because they are awesome. Go for Pro Plus, most bang for your buck, unless you're like a super high frequency day trader, then go for Premium. Okay, so what we're looking at here when we turn to the chart is QQQ, the NASDAQ, from the top of the dot-com bubble all the way to when it finally recouped its losses in about September of 2016. You can see here that's a 0% return. And I can measure any return by hitting shift-click here, and that's what I did. That's 6,028 days of no return. But let's think about what that actually means. That means that someone bought at the top of the dot-com bubble, did nothing as it fell, did nothing as it rose again, did nothing during the Great Recession, did nothing as it rose all the way back to 2016. There might be one guy, maybe, who did that, who probably bought and then died, and then it's just a lost account somewhere. But that's not what realistically happens. Anyone who has their wits about them and knows how to invest intelligently would be buying this dip on the way down. And the more you bought as this went down, the faster you'd recoup your losses. In fact, if you leveraged your buying more and more and doubled how much you bought every month it went down, this period as it rose up into the Great Recession, you'd recoup probably all your losses and then some. So the more you buy as it goes down, the faster you can recoup your losses, even if from point A to point B, you have a flat return. And this does not include dividends, which TradingView allows you to adjust for by just clicking a button. So if I click on dividends, now we can see it recoups even faster. So it recouped by 2016 of September of 2016, right? So if we go all the way over, now it's recouped by July of 2015. So it saves you by a year. And then you could say, well, what about inflation? And I would say, dude, no one ever talks about inflation. We're talking about stock returns. If you're making any sort of returns, you're combating inflation. Who cares what your return is with inflation? That's not really that important, because if you're just holding cash, that's the thing that's going to be eaten away at. If you're making any sort of return, then you're fighting against inflation. So I could adjust this chart for inflation. And in fact, in my profile, I have a tutorial on how to do that and to adjust it for taxes. But my point is, people only ask for inflation-adjusted returns once you say, have you accounted for dividends? And then they go, well, have you accounted for inflation? Have you accounted for taxes? And it's like, well, dude, you have to at least account for dividends. And if you are making any return, then you're combating inflation. So who cares what inflation is? As long as you're making money, right? You're combating inflation. Okay, so there's that. So two things. One, buy the dip, you recoup your losses faster. Two, there's dividends. That means that even if you did lump sum, it's not all the way to 2016, it's 1 year earlier. And if you, bought as it went down, you'd also get more dividends. And the more shares you bought down here, you get more dividends so that you would recoup your losses even faster. And so that's the NASDAQ. That's my thoughts on that. So when you think about what's happening right now, when we're in this bear market, and there's a lot of fear going on, and people are scared to just throw their money in the stock market. It makes sense because you throw it in and then you watch it just disappear by 50%. It's not very fun. It's no longer become stocks only go up. It's stocks maybe go up, often go down. And so a good hedge against this is just dollar cost average, which means just take a percentage of your portfolio and have your set stocks that are good stocks, that are companies you like, companies, not just stocks. Don't think of them as just stocks, but companies that you like. Maybe some ETFs, VU is basically SPY with low expense ratios. QQQM is the same as QQQ, but has a lower expense ratio because it doesn't have options, a little less liquid. There's other Vanguard ETFs. Whatever. You have your select asset for it, and you can do bond funds if you want to be a little bit more cautious, like BND. That's the go-to bond fund. Pays coupons out as dividends. And so have your asset allocation, and then dollar cost average, take a percentage of your paycheck and just plonk it in once a month. And as the stock market goes down, you're going to be buying at cheaper and cheaper prices so that when it ultimately recovers, you will recoup your losses much, much faster. And back in the 1960s and 1980s, it was kind of the same deal, especially as far as dividends go, as far as how it affected the returns during that time period. So yes, it is possible for it to trade flat, but you can recoup your losses by buying the dip, and I would not be shy of doing so. And if you don't want to lump sum invest because you're scared of just buying all now and then it just trades down and then back up over 16 years and you're that one guy who did that, then trickle money in. Buy the dip, right? Not financial advice. I don't even think that legally protects me, but that's my personal opinion on the matter. And if we look at Japan's index, Nikkei, I think is how it's pronounced. I'm pretty sure on CNBC they pronounce it like Nikki, but Nikkei is there's a period of time where they call it Japan's lost decades, and it was a time where Japan's stock market, equity market, rose pretty much exponentially. It was way overvalued, then collapsed, and then over like 30 years, basically traded flat. It took a long time to recover. So here we're looking at Japan's Nikkei 225 index, and here are the lost decades, basically. Lump sum investing is this red line. You throw in $300,000, down it goes, back up it goes, back up it goes. And after 30 years, you're at $267,000, and it takes a little bit longer than that, and you finally recoup all your losses. So 30 years, and you actually still lost money. Lowever, if you had instead started at $0 and just dollar cost average consistently each month, you would cross past lump sum investing in 2003, which is about 20 years before lump sum investing finally recoups its losses. And by the time you hit 30 years in, you'd be at $606,000, while lump sum investing would be at $267,000. So people will often look at the QQQ from .com to 2016 and say, it was flat, bro. Or they look at Japan and they go, lost decades, bro. But really, if you're consistently buying over time, it's negated. Plus, there's dividends that play into it as well. Well, what about inflation, bro? Fine, factor in inflation if you want. But if you're making any money at all, you're fighting against inflation, and that's all that matters. So don't let them get to your little brain over there, donut boy. I don't know why I called you that, but just don't let them get to you, because if you're scared of things going down more, don't lump sum. Okay, just take a little bit of your. You should have savings. You should have some cash to spend. That's liquid cash, ready to go, and you should have consistent reinvestments into your set asset classes, and that's it. It makes it a lot less scary, and you'll recoup losses much faster, because a lot of people were buying as things were going up, as quantitative easing was all the rage, and people thought it would never end, and then it ended, and people were like, oh crap, and now things are going down, and people don't know what to do anymore. Buy the dip, in my personal opinion. I said it multiple years, like 2 years ago. I said if the Fed raised interest rates quite harshly, which I said they probably would do, because they take a lesson from Volcker from the 70s or in the early 80s, be early 80s, and they would not hesitate with interest rates. They'd raise them up really fast, which is exactly what they did. And I said there'd be a stock market correction, which there is, and I said I'd buy the dip, which you should. And that's how you're going to recoup your losses faster. So don't get fear mongered into thinking it's going to be flat for decades. It could be flat for a couple years. Who gives a shit? Like, how old are you? Even if you're 55, if it's flat for a couple years, who cares? And if you're 25, especially, who cares? But the way to keep your brain on an even keel is to just be consistent. That's how you stay sane, is stay consistent. Have a plan and stay consistent. The people who are a little bit worried are the ones who put a lot of money in at the top and now don't know what to do anymore because they don't have money to dollar cost average. And for those people, I would say invest in other aspects of your life and leave your stuff alone for right now, depending on the investment. You might want to talk to your investment advisor or somebody, but don't let them shove you into mutual funds. They always do that, dude. Investment advisors, they're like, we don't want happy clients, but we don't want mad clients. We'll take ones in between that see a little bit of green. So they take your money and they diversify it into like 50 mutual funds, which within the mutual funds have like 100 holdings. So you're holding like thousands of stocks. And it's like, cool, great. I get my 2% return a year, but the clients are happy because at least they're not losing money. Anyway, I've just seen that a lot with investment advisors. I used to have one, and he did the exact same thing. And in my opinion, it's stupid. But yeah, if you're struggling, like you put all your money in, you don't have any extra money to buy the dip, don't like panic buy. Just throw in $1, throw in $2, just throw in a tiny little bit. And work on having savings. Savings is first. Investments is second. It should go high interest rate debt, pay down, add to your savings, and then have a high savings rate. And then depending on how many dependents you have, it should be higher. And then invest in stocks. So if you've already invested in stocks and you don't have savings, a little late. Let's go back to savings, add up into savings, and then you can start, while you're doing so, you can throw $1 or $2 at stocks just to buy the dip as it's going down, because we don't know when it's going to recoup, and it could keep going down for a couple of years. Who knows? Or trade flat. Just throw in $2, and once you have your savings saved up, then you'll have plenty of time probably to add to your stock portfolios to help recoup losses and make gains for retirement. Remember, for people, this is mostly for retirement. People forget. People follow me because they love options trading and stuff. I like options as far as leaps go and running the wheels go, especially when you run the wheel in a Roth, because like right now you can run the wheel in a Roth IRA or a traditional IRA, well, Roth IRA preferably, and you can basically get returns that you otherwise would not have as the stock drops. The wheel tutorial will pop up in the corner here, and because you're limited to how much you can contribute, $6,500 I think for 2023, and then eventually if you have too high of income, you can't contribute at all. So any amount that you can generate out of thin air and put in your Roth is great. And so the wheel is a good way to do that. I kind of lost track of what I was saying. So yeah, high debt, pay that down, savings, then invest. But if you've already invested, just throw $1 or $2 and save into investments while you're getting your savings built up, and then you can start aggressively going for investing, right? And of course, it all depends on who you are, how much money you have, how much money you make, how old you are, what your living costs are, et cetera, et cetera. So I can't give a blanket statement entirely, but that's a general rule of thumb. Use your own brain in there. That's what it's there for, to analyze your own situation financially and decide what's best for you. The worst thing you can do is panic, unless you bought BBBY, in which case you deserve yourself. I'm very sorry. Okay, that covers it. Please subscribe if you learned something or you liked the video or whatever, and sign up for TradingView. Go for Pro Plus. Most bang for your buck, in my opinion. And follow me on there. I'm on there as well. And when I have the energy, I type ideas out that are both good and bad. I love each and every one of you in a special and unique way. This is In the Money. Peace out.